Hi, in this video we'll be talking about short-term debt funds. So for your very short-term investment need, liquid fund is something that you can consider. However, for slightly longer duration, and if you're looking for a fixed income kind of instrument, then short-term debt fund can be considered. Now, a short-term debt fund would invest into those instruments which have a maturity period of anywhere between 1 to 5 years. So if your investment horizon is anywhere between 1 to 5 years, you can invest into a short-term debt funds. So let's learn more about short-term debt fund. Let's dive in. So a short-term debt fund would have an investment horizon of anywhere between 1 to 5 years, and your investment horizon, if it matches with the investment horizon of the instruments, then your risk goes down considerably. Now, what are the risks that is there in a short-term debt fund? So the risks there are two kinds of risk. One is the credit risk and the other is interest rate risk. Now, in the credit rate risk, and what it means is that when we give out loans to different companies, and if the one of the companies shuts down, then there could be a scenario wherein our principal would not be returned, or the interest would take a beating. So if that happens, that comes under the credit risk, and whenever you give out loan, this risk would always be there. So that's why it's always important to invest in those funds which are investing in companies that are highly rated. Now, the second kind of risk is the interest rate risk, and this risk is there because of the interest rate going up and down. Now, what are the advantages of investing in a short-term bond fund? So one is the liquidity. It's pretty liquid. So let's say you invest 10 lakh rupees and you want 5 lakh rupees out of it, you can actually do that. Whereas if you invest in an FD, you would have to withdraw the whole amount. It's tax efficient. Let's suppose you stay invested for more than 3 years, then you get that indexation benefit. So the inflation would be taken into account while calculating the tax that is due. And because of this indexation benefit, the tax outgo would actually reduce quite a bit, because in India the inflation rate is always close to 6%, 7%. And in case if it goes up higher, then you might not have to pay tax at all. So it's better than FD because it's liquid, it's tax efficient. FD is not tax efficient at all. Whenever you invest in an FD, there's a TDS that's deducted every year. So that way the amount actually goes down a bit, right? So these are the advantages of investing into short-term debt fund. Now, the other example are Gilt, which is government issued long-term. FMP is fixed maturity plans, and then you have junk bonds. So I'll quickly go over them. We need not go over them in detail, because as far as investment is concerned, it's best to invest in a short-term fund if you're looking to invest in a fixed instrument kind of a thing, because Gilt, FMP, junk bonds. Now let's discuss Gilt first. Gilt is long-term, and when you're talking about long-term, like 10 years in this case, interest rate movement can adversely impact you. It can go in your favor as well, but it can impact you as well in case if the interest rate goes against you. And when would the interest rate go against us? When the interest rate is rising. That's when you would be incurring the capital loss, or you can say notional loss. If you stay invested, great. But if you need the money and the interest rate is going up, you would have to withdraw your money at a loss. So rather than being adventurous, what we can do is we can stick to short-term funds. If we want better returns, then we have equity funds for that, right? We need not take this much risk in a debt investment. Now, FMP is fixed maturity plan. This is much like FD. It gives you an indicative return. So again, it's a closed-ended fund, so you would not be able to take out your investment for that period. If your investment horizon matches with the FMP, then there is no risk or almost no risk, and you would get that indicative return, which would be close to 8-9% depending on the interest rate scenario at that point of time. Now, since it's a fixed maturity plan, we know the maturity period and you cannot take your money out. The risk is not there, because even if the interest rate goes up and down, just like here we discussed, the interest rate goes up and down, but if you stay invested for 10 years, you would keep earning 8% interest rate, and at the end of the 10 year you would get this money back, the principal back, right? So same is the case with FMP. Here you're getting you know the duration for which your money would be locked, and since the money would be locked, I would not encourage you to invest into something like this. However, in case if your investment horizon matches with FMP, you can by all means go ahead and invest in it. The next is junk bond. As the name suggests, the investment is into those companies which are not credit worthy. And since they're not credit worthy, the interest rate that you get out of them is high, because nobody is willing to give them loan, and that's why they're willing to offer higher rate of interest, right? Again, we don't have to take so much risk. We don't have to take a higher credit risk, because our principal would also be at stake here, because in case if the business is not working or the company shuts down, our principal would be at risk, and that's something that we do not want. So if you want to increase the risk, we might as well invest into equity funds and not in junk bonds or in gilt funds. We would avoid that. So we would next be covering equity funds.